Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook. And today on Options Guide TV, we are taping the show. It is Thursday, March 28th. The markets are open and rocking and rolling on this Thursday, but they are not going to be open on the Friday for the usual time for Options Guide TV. So I'm just going to extend the show that we did on Wednesday where we looked at our deep in the money call portfolio of stocks and we made some adjustments. We ran out of the time. We didn't finish all of the adjustments, but I do want to show that they did take place. We looked at our biggest position winner that we had, which is Nvidia. We started with 4 calls. We sold a couple of calls and we rolled the strike up from the 320 strike with a shorter term expiration, which was this expiration, the 17th of January 17th of 2025. And we rolled up in strike and out in time. So now we're looking at 449 days versus 295 days on Eli Lilly and a lot of the other option contracts that are in here. So to keep with the theme, Eli Lilly is our next biggest winner so far. That position is up $25,000 or 41%. And once again, we started with a $200,000 portfolio. We had about $100,000 of that $200,000 portfolio allocated. We had a couple of stocks, or one stock in particular, that got called away, Caterpillar, that ran up through our short call strike, and we weren't able to adjust it, so we closed that position out. I still want to go back and look at a good industrial stock to try to add to this position, but I decided that today is going to be the time for us to add some small cap in this position. We have a lot of large cap stocks here already. Let's go back and look at some of the small cap stocks. We also need to add a couple in Home Depot. We only have one option contract, and it kind of ran away from us. That position on that one contract is up 68%. So the stock ran away. I was kind of hoping for a little bit of a pullback to be able to add some more to this paper trading portfolio. But now we're just going to take our crumupsins and we're just going to add a couple today to get some market value in that range, because we took a lot of money off the table with Nvidia. So we have a lot of cash in this account now. We also had a Charles Schwab position on Wednesday. We were short a call option and we were in danger of that call option actually getting a sign. Schwab was trading right around $72. So we just closed that out. We ended up making a dime on our short call position, but we decided that we just did not want to take the risk of being assigned on the Schwab position. All the goals, whenever we sell call options, we are doing it on a surrogate for the stock, which is a deep in the money call option. And that position in the playbook, I call the fig leaf. And because of that, we really don't want to be assigned. Here's the concept of the fig leaf, and where we came up with the name is that you're kind of covered. As far as the brokerage firm is concerned, you have the right to buy the stock at a lower price than you're taking on an obligation to sell the stock at. There's different expirations, which adds a little bit of a dynamic, but you don't own the stock. If you just own the stock and you get assigned on a short call, i.e. a covered call, well, they can just take the stock. That can happen in the middle of the night without you having to do anything at all. They just take your stock away. When you have deep into money options, that is not the case. You don't own the stock. You have a lot of time premium probably still in your option contracts. You don't really want to just exercise that option contract. So that's why I say we're kind of covered. It's a lot more work than a covered call position. All right. But you do reap some benefits because you also have limited and known downside because you're just buying that option contract. The other one that we rolled, we had the Google 150 call options, and we see Google was right at 150.66 right now. This is a live market. So we rolled out further. We had to go all the way out to the 26th to get a decent net credit to the account, and we rolled up to the 155. So right now that is the only position that we have a covered call on. So let's start by doing what I mentioned on Wednesday's Option Guide TV. Let's do the same thing that we did with NVIDIA. This is a way deep into money option contract at this point in time. So we're going to take Lily, we're going to roll out to the June contract because we want to stay in Lily, add some more days to it, take some money off the table, and go deep in the money on a longer term option contract, but it won't be quite as deep as this. We'll roll up to an 80 delta option contract. So right now we're seeing the deltas coming close to one, right? So in this instance, we have 3 contracts on Lily, and the delta, if the delta was 1, it would be at 300. So it's just a smidgen below that. It's at 285 for the position delta on Eli Lilly. But let's go to the options grid. Let's go to Lilly. Inside the TradeHawk software, the options grid is showing you that you have this option contract with 295 days remaining until that expiration date. And we are highlighting, we're going to stay in that position. We're going to be buying that option contract back. So let's go into the paper trade portfolio. Let's click this and send to ticket. All right, so we're looking to sell to close on this scenario. Now we have to go back to the options grid. We see that we have the 3 lot that's in here on the 520 strike call option. We now want to go out further in time. We're going to go to that June contract, and that expiration is June 20th, 449 days away. We are now with that expiration up, and we'll highlight over here that expiration is there. We want to look for the 80 delta on the call side of things. So if I scroll down a little bit here, we got to decide which option contract we want to be in. Wow. Okay. Here's the bid ask. The bid ask moved on me. Apologize. It should have been over here. I don't know how it got here. But in this instance, we're looking at 195 by 199. So we got a fairly large market on this. And there's going to be a large market on this one that we're closing. That's 290 by 296. So this is the battle that I've talked a lot about deep into money option portfolios. The bid ask spreads are way too wide relative to the stock, and you're buying something that's a surrogate for the stock, but that is your biggest battle when we're looking at these option contracts. So we're going to roll up and strike, and I think we're going to go to the 78 delta option. That's 4 points wide. This one also is 4 points wide. Extrinsic value, you got $79 worth of extrinsic value of time value still in that option contract. So yeah, let's do this one. Okay, so here we go. 78.94, so that's 79. And now we are going to be buying to open those option contracts, and we're going to do 3 of them. We're going to keep the exposure, and we're going to bring in a $96 net credit to the account. So if you go 96 times 300, that's $28,800 that we're looking to bring in. And so we have this position. We're going to hit send on this and send this to the trading floor. So here we go. We are selling to close 3 contracts of the 520 strike call option at the same time. Buying to open the June, different expiration, the June 20th, 2025, 670 strike call option. We're going to do this for a net credit to the account of $96. Hit send, confirm that that is correct. And yes, there we go. 96.05. We might have to adjust it. That order's been sent to the floor. Let me make it because it is a paper trading portfolio, we really need to get a little bit. 96 is the midpoint. I don't think we'll get filled there. We're going to have to go down to about, let's go to 94 and let that one ride at around 94. I think in the real world, 94 would be possible to get a fill on, but you never know until you know. All right, so I'm going to put it, I moved it down from 96 to a net credit of 94. We'll replace that. And then little pop up on my other screen. Are you sure you want to replace the order? And the answer is yes. All right. And then underneath my picture, you will see that order has been adjusted to a different strike price. It's not filled yet. Now let's go back to the portfolio. We're looking at Home Depot. Let's add a couple positions on there. In Home Depot, we only got about $5,600 worth of market value. Let's add 2 more positions in Home Depot. So we want to stick with that same option contract. Actually, we might roll this one up. Let's roll this one up and out too, because we only have one of them, and we are up quite a bit on that position. The delta's right at 1. Okay, so it's time to roll. So here's a great example of the way the delta is anyways. So you have one contract, and if the delta's 1 times 100 means that your delta is 100. So at this point in time, we're way deep in the money. This is acting like the stock. You're getting a delta of 1. We don't need to keep this much risk on the table. It's a $55 option contract. We'll roll it up and probably make it like a $30 option contract or so and take a little bit off the table, and we'll add 2 positions to that. So let's do the same thing that we did here. We're going to close that out. We're going to take this option contract. We're going to send it to the ticket. And there we go. So now we're seeing a sell to close of that one contract. Now this will be a ratio, so it'll be a little bit different when we're looking at the net credit, but the TradeHawk software will do the math for us on this. We'll go in here, type in Home Depot. All right, so we got the January contract. We're seeing the 300 strike option contract. There's a lot of open interest on it, which is good. And we're trading here 94.10 by 94.65. So not a horrible market by any means. Let's scroll out to the June contract now. We got our 1 position in there. We're going to roll to the 80 strike, which is 70 right here. 80 delta 79 right here. So this is the 79 delta. Let's roll up to that, which is the 350 strike going out to June 20th, 2025. And we're going to add a few more contracts to this. So I keep wanting to click over here, but this is where the bid and ask is at. So let's add this one, and we'll do 2 more contracts. And so this is showing that we're going to pay a net debit to the account. We're doing this on a 1/3 ratio. So we're selling 1, bringing in $95, but then we're going to end up buying 3 of these. And so so I'm just going to send this to the floor. 42.90 is on the downside. The midpoint is here. Let's go 43. Got to give up a little bit more in the paper trading to try to get these things filled. Let's go 44. All right. And we're going to send that to the floor. Answer is yes. All right. And that order has been sent. So let's go back and look at our orders, see where we're at. The long diagonal credit that has not quite filled yet. We still haven't filled on any of these. So let's take this diagonal, look at where we're doing. We're at a limit of 94, and the market right now is at 91. Let's adjust it, and let's go down to 93. We got to keep working the order. Net credit, and we'll hit replace. Are you sure you want to replace the order? The answer is yes, and we're giving up $1. And this is the battle. I mean, that was a full $1 that we're going to have to go down. But once again, this is a paper trading portfolio, and in the real world, you may get better fills, honestly. So there you go. Net credit to the account. All right. Now I want to add. We've been talking a lot. Oh, I'm not going to be able, I don't know oh, good. IWM came up. We've been talking a lot about IWM and the Russell 2000 and the fact that indexes in general, small caps usually do fairly good if there's a rate cut coming. And according to the futures, there's a higher probability of a rate cut in June than them doing absolutely nothing, and them being the Fed. So I saw this today where I mentioned that if we can, we looked at a long straddle right about here, way back here, and we saw this long straddle. It came back and it pulled back again, and it's really trying to establish itself on a new high. So today, I think it's today we're just going to buy some deep into money Russell call options, and IWM is an ETF that tracks the Russell 2000. We're going to go back to the trading tab. We're going to type in IWM, and that's where we're going to finish it today. We're going to leave it with a new position in our account because we've generated a lot of capital. We generated a lot of capital by rolling up the NVIDIA. If we roll up the Eli Lilly, we're going to have even more capital in the account. So it's time to allocate into a couple of different positions. Now we can add, like we did in Home Depot. That's one thing that we can do because we have more capital. We can add more capital to some of the other positions that we have in the account. But I want to add about two more throughout this year, 2024. I want to add this stock IWM, and then we're going to go and add um, some type of industrial. I still haven't figured out which one I want to do yet. So here we are. IWM, this is the June contract. We're going to stay with that. We're going to scroll down. We're going to look at the delta right around 80 in this instance. We are in the June contract, right? April, May. There it is. 449 days away, 06. Delta of 80 is right here. And market's $1 wide. It's not ridiculous. We got open interest here of 1,750. So here's a great example. We have really good open interest on this 200 strike, and that's a nice big round number. But that delta is 73. I would like to buy that because of the open interest, and the market is pretty strong here. 30.13 by 30.89. It's not a bad market. These other markets are medium, but I see the next one. This is closer, and we got a good amount of open interest there. That helps with liquidity, having open. We'd rather have open interest than not have open interest when you're looking to get into a position. So here we're going to take this one. I'm not going to do the exact 80 delta, even though there's decent markets here. I just like the fact that there's more open interest at this point in time in this option contract. And if we have to adjust it, that might help us. So we're about 1 point wide. We're going to hit the ask here, $33. Let's take, so for every one contract, it's going to cost us $33.84, $3,384. This is a little bit lower priced underlying relative to the other ones. It's still an expensive stock, but we're going to take this and we're going to buy 5 of these, and that's going to put in about $16,000 into that out of our portfolio. So we're going to add 5 to this position. And this is our limit price, and this is our order. So we're going to have to, once again, it's paper trading accounts. We got let's go 34.05. So we're looking to buy 5 of the June 20th 2025 expiration 195 call options. We're doing this at a limit price of 34.05. Good for the day, and we're going to send that down to the floor. All right. So we have accomplished a lot for our holiday event, I guess, of adjusting the deep in the money call portfolio. I'm going to work these orders. I'm not going to let them not fill. We haven't filled one yet. Want to get this one I thought would fill fairly quick. Let's click on that. 34, 30. Okay, let's go 20. Let's put it at 20. Let's just get this one filled, hopefully, before we end today. Answer is yes. Okay, so That's going to be it for this edition of Options Guy TV. We will be back on Monday doing a full-blown show of Options Guy TV. We will maybe take a peek at the paper trade portfolio, but we're going to go back to looking at our SPX option contracts and doing a weekly trade in the S&P 500 index. I will definitely get a screenshot of the portfolio showing that these orders were filled, and we'll just review that on Monday too. So thanks for coming, everyone. Click subscribe, ring the bell so you get all the alerts if you're on the Tradier YouTube channel, and we'll see you this coming up Monday. I hope you have a very happy holiday.
All opinions expressed by Tradier Hub contributors are solely the contributors' opinions and do not reflect the opinions of Tradier nor its affiliates and/or subsidiaries. You should not treat any opinion expressed by Hub contributors as a specific inducement to make a particular investment or to follow a particular strategy, but only as an expression of their opinion. The contributors' opinions are based on their own personal research, but neither Tradier nor its affiliates and/or subsidiaries warrants its completeness or accuracy, and it should not be relied upon as such. Any trades or positions discussed or referred to by contributors may or may not be actual live trades or positions. Such information is not intended to be financial or investment advice. Tradier Inc. is the parent company of Tradier Brokerage Inc. Tradier Brokerage Inc. and Tradier Inc. are separate entities with their own products and services. Securities products and services are offered through Tradier Brokerage Inc. Tradier Brokerage Inc. is an independent subsidiary of Tradier Inc., all rights reserved, member FINRA SIPC.